Welcome to CatEye US Stock. We watch markets with calm focus and sharp instincts. Markets are closed for Martin Luther King Jr. Day, but there's plenty to unpack before Tuesday's open. Looking back at the past week, the big US indexes slipped modestly, while small caps and several cyclical sectors quietly pushed higher. It was a week of consolidation near all-time highs, with rotation under the surface rather than broad selling. That calm backdrop matters because the narrative has shifted sharply over the long weekend. Tonight, we'll connect how last week's fragile stalemate is colliding with new geopolitical and policy shocks as markets get ready to reopen. Looking back at the weekly tape, this was a controlled pullback, not a breakdown. The S&P 500 slipped about 0.4%, the Dow lost roughly 0.3%, and the Nasdaq gave up around 0.7%. All three printed small red weekly candles just below record territory, with no major support levels under threat. In sharp contrast, the Russell 2000 rallied around 2% and extended a powerful outperformance streak versus the S&P. That divergence tells you the market was broadening, even as the headline indexes looked tired. Rising Treasury yields toward the 4.2% area on the 10-year added some friction for high multiple growth, but price action on the week still looked like digestion in an ongoing bull trend. Building on that index picture, the real story was where the money went. Over the past week, leadership flipped away from mega-cap growth and into classic cyclicals and rate sensitives. Real estate, consumer staples, industrials, energy, and utilities all posted solid weekly gains, with industrials and energy echoing confidence in the real economy backdrop. At the same time, financials, consumer discretionary, communications, and parts of healthcare lagged, even as some big banks beat earnings. Information technology finished only slightly weaker overall, caught between profit-taking in crowded AI winners and a powerful lift in semis after TSMC's results. Put it together, and the message is clear. Investors weren't abandoning risk, they were broadening it, rotating from narrow mega-cap leadership into small caps, cyclicals, and select AI infrastructure plays heading into this volatile holiday weekend. Over the long weekend, the narrative flipped from cautious to defensive. President Trump's sudden threat to slap a 10% tariff, rising to 25% by June on 8 European countries over the Greenland dispute, slammed European markets on Monday and has U.S. futures pointing sharply lower. At the same time, reports of a Department of Justice criminal investigation into Fed Chair Jerome Powell over testimony on building renovations escalated the ongoing White House versus Fed feud into a direct institutional risk. The market's reaction has been anything but standard. Gold exploded to fresh all-time highs near $46.90 an ounce before cooling off, while Bitcoin dropped roughly 3% toward $92,500, trading in line with risk assets instead of hedging them. Most importantly, the 10-year Treasury yield pushed up to around 4.22% instead of dropping in a classic flight-to-safety move, a clear sign that investors are bracing for tariff-driven inflation pressure. Heading into Tuesday's open, that combination of trade shock, Fed uncertainty, and rising yields is the lens every asset class will trade through. With U.S. markets closed for Martin Luther King Jr. Day, attention turns to what comes next. Earnings season is the next major catalyst, shifting focus from daily price moves to company fundamentals. As results start to roll in, guidance and forward outlooks will matter more than headlines, and market volatility typically picks up as expectations get tested. This earnings season carries added importance. In several sectors, valuations are still elevated, leaving less room for disappointment. Investors are watching margins, cost control, and revenue growth closely. More than simple beats or misses, earnings season tests whether current market narratives are actually supported by fundamentals. Technology continues to play a leading role in the market, with AI-related companies facing especially high expectations. Investors are focused on capital spending, profitability, and management guidance. Even strong results can trigger volatility if guidance doesn't live up to those elevated expectations, especially in a market with concentrated leadership. Banks are typically among the first to report, making their results an early signal for earnings season. Investors focus on net interest margins, credit quality, and loan demand to gauge economic conditions. Bank guidance often shapes early market sentiment, even beyond the financial sector itself. Stock reactions during earnings season are driven more by expectations than by results. Guidance often matters more than the headline numbers, and positioning plays a major role. Even strong earnings can lead to sell-offs if optimism was already priced in. Earnings season basically compresses months of expectations into just a few days. As earnings season unfolds, the most important signals are the patterns that emerge. Watch for guidance trends across sectors, whether leadership broadens beyond megacaps, and how margins evolve. How stocks react relative to their fundamentals will determine whether recent market trends are confirmed or challenged. First up on the single stock side is TSMC, a defining mover this past week. Shares surged after a blowout fourth quarter and a massive AI-heavy capital expenditure plan of $52 to $56 billion for 2026. That guidance cemented the idea of an extended AI hardware supercycle and gave demand visibility to key U.S. chip designers and equipment makers. Heading into Tuesday's risk-off open, the question is whether that earnings gap holds. If buyers step back in quickly, it would signal that long-term AI conviction is strong enough to look through near-term tariff and yield volatility. Nvidia is a critical week-ahead watch. Even without a specific catalyst last week, TSMC's commentary repeatedly underscored Nvidia as a core driver of advanced AI node demand, reinforcing the structural bull case. But the macro backdrop has changed. With the 10-year yield pressing toward that 4.25% line, Nvidia's rich valuation and long-duration cash flows make it vulnerable to a rates-driven derating. Into Tuesday's open, this stock will tell you whether AI dip buyers still have the upper hand or whether macro fears finally override the AI growth story. Microsoft quietly outperformed the broader tech complex last week, ticking higher even as the Nasdaq slipped. That relative strength reflects its role as a core AI and cloud compounder with durable cash flows, effectively a defensive way to own the AI theme. As tariffs, bond yields, and political noise rattle risk sentiment, Microsoft becomes a key barometer. If it holds up well on Tuesday and into the week, it suggests investors are rotating within tech rather than abandoning it. A decisive break lower, by contrast, would be an early sign that even perceived quality isn't immune to this latest macro shock. Apple ended the week on a softer note, caught on the wrong side of rotation as money moved out of some mega caps. It sits in a nuanced spot. On one hand, it's a major TSMC customer and integral to the AI-enabled hardware ecosystem. On the other, it faces ongoing questions about smartphone demand, regulatory pressure, and growth versus valuation. With futures pointing lower into Tuesday's open, Apple's behavior around recent support zones will matter. A resilient bounce would argue that this is still an orderly rotation. A failure to hold could signal that the market's starting to de-risk more aggressively from the biggest index weights. ExxonMobil is a key past-week mover and a name to keep on the radar. Energy was one of the best-performing sectors, helped by steady oil prices and simmering tensions around Ukraine's infrastructure and unrest in Iran. For many investors, ExxonMobil is a way to combine dividend yield with a geopolitical hedge inside an equity portfolio. As the Greenland shock tariff story unfolds and Davos headlines hit, cross-asset volatility could rise, especially if crude responds to any new supply or demand fears. How ExxonMobil trades this week will help confirm whether energy can continue to lead in a risk-off, inflation-tinged environment. GBTC is our proxy for how crypto is behaving into this shock. Through the past week, strength in Bitcoin near the mid-90,000 range supported GBTC and fit the broader risk-on tone across small caps and AI. Over the weekend, that relationship flipped. Bitcoin dropped roughly 3% alongside equity risk, undermining the idea that crypto is acting as a safe haven. GBTC's reaction around Tuesday's open can offer an early tell on speculative risk appetite. If it stabilizes quickly, traders may still be willing to embrace high beta themes. If it keeps sliding, expect that caution to spill over into growth and small cap equities. We'll close the stock focus with the S&P 500 itself, because it frames everything else. Last week, the index slipped roughly 0.4%, but stayed close to record highs. More importantly, breadth improved as money moved into cyclicals, rate sensitives, and small caps. That's the profile of a healthy rotation market. Now the index has to absorb the combined hit of the Greenland tariff threat, the Powell investigation, and a 10-year yield pressing higher. Tuesday's open will test whether the S&P remains a shallow dip by the rotation environment, or whether this is the moment where investors step back from risk more broadly and force a deeper repricing. Heading into the new trading week, everything starts with Tuesday's open. Tariff headlines around the Greenland dispute and the tone from Davos will set the macro mood, while the 10-year yield around that 4.25% line is your primary risk gauge. A decisive break higher would likely pressure high-valuation software, semis, and other long-duration growth names, regardless of last week's AI optimism. On the data side, durable goods, confidence readings, housing reports, weekly jobless claims, and producer prices will all feed the soft landing versus inflation scare debate. Layer on top a heavy earnings calendar, where guidance and margin commentary matter more than simple beats or misses. Use the early part of the week to observe, not react. Wait to see whether yields stabilize and whether corporate commentary supports or contradicts the market's recent rotation into small caps and cyclicals. Pulling it all together, the past week ended with a market that was rotating and broadening, not breaking. Small caps were leading, cyclicals were catching a bid, and AI hardware remained a powerful earnings pillar. Over the MLK weekend, the Greenland tariff threat, the Powell investigation, and a jump in gold flipped that calm into a defensive, risk-off setup. The real tell now is the bond market. If the 10-year yield pushes convincingly above roughly 4.25%, high valuation growth and software are likely to feel real pressure, no matter how strong the AI story looks on paper. Get some rest, keep your focus on yields and earnings guidance, and let Tuesday's first few hours of trading show you whether this is a buyable scare or the start of a deeper reset. Thank you for watching CatEye US Stock. Stay curious, stay calm, and we'll see you next time.